All right, what a way to kick off the month of September. We were waiting for that post-holiday, for that volume to pick up, for the professionals to come back from vacation, and boy did they. And they were selling stock this week. Welcome back to Stock Market Weekly. I am your host, Evan Medeiros, for Friday, September the 6th, 2024. Let's get right into it here. We had the jobs report out this Friday, and the report was sort of a mixed picture. Really didn't tip too hard one way or the other. Didn't really imply that the economy is falling off a cliff. It also didn't look all that rosy either, and that uncertainty is perhaps still playing into this sort of potential growth scare, we'll say, that the market is going through right now. We saw tech selling continue to intensify this week. We've been talking about that relative underperformance for the Nasdaq 100, so it shouldn't have been that much of a surprise. Certainly the intensity picked up this week, and we're going to talk a lot about that when we get into some charts. We've got the VIX over 20. We also had oil rolling over hard this week, and that was sort of putting additional pressure for energy stocks and just the impact on markets generally speaking. The one good point in the market right now is that credit markets really don't look like they're stressed, worried, or panicking. Of course, most importantly here, we're going to be mapping this market pullback. We're going to try and make some sense of where the heck we are in this technical landscape. Stick around. Let's get into it. All right, we're back. We've got some charts in front of us. TC2000, that is a charting platform we use throughout these videos. It's a platform we support here at the Trade Risk as well. We've got lots of cool downloads, add-ons, features, customization that you can apply to this platform. So if you aren't a user, we do have a referral to TC2000 in the description of this video. And then check out our website, thetraderist.com. Click on that TC2000 page, and you'll see all of the guides, downloads, and tools that we have available. Now let's get into the numbers here. You can see it was red right across the board, and firmly so. So take a look here. Dow Jones did fare the best. Remember, Dow Jones closed at all-time highs last week, and now this week it's down almost 3%. 4.25% lower for the S&P, 6% for the Nasdaq, and just about 6%, 5.5% for the Russell 2000. Now, here is the impressive stat, is the middle column here is 1 month returns, and we are still actually green here over the past 1 month, and that shows easy come, easy go, right? We had a very fierce, sharp up move in August, and now we are in the process of deflating that momentum. We are giving back that sharp, fierce snapback rally we saw throughout August. We're going to talk about that a lot in this video. Take a look at volatility across the board. It's up this week. The VIX is back over 20. The Nasdaq falls at above 25, and Dow Jones at sub 20 still, but that sort of tracks. If we take a look here at our smart trend filters, notice we are starting to break down, roll over, and pressure the daily uptrends. Now, let's move into sectors here this week. So there were some things that were green this week. There were a couple of standouts here with staples, and it was real estate, which actually enjoyed a nice sort of rebound, gave some gains back, but I think real estate there enjoying sort of the lower mortgage rates, just the lower rates, interest rates generally for builders is helping. Utilities was the third spot, still down slightly on the week. On the downside, though, technology, 7.5%, a brutal place to be this week. Energy, not far behind. That oil breakdown was fierce, so 6% down there, and materials down almost 5%. Once again, look at this middle column here. 1 month returns still green for most areas of the market. It's really just energy now that's moved into the red. Obviously, we'll need to see what next week brings, but for now, this is a pullback, right? I know it sounds, counterintuitive, but it is a pullback to that August rally that we saw. We're going to talk more about that in just a minute. If we take a look here at our sector trends, you can see that most of these trends now are starting to get under pressure. Now, this is our smart trend filter. It measures price volume spanning across time. It also looks at price action relationships. And this is a daily time frame across all sectors. And what you'll notice here is technology did produce a fresh sell signal this week, went red. Most other sectors here are starting to print these yellow dots. These yellow dots basically mean, hey, there's turbulence, there's some cross signals here, there's mixed signals, right? Pay attention, go closer, drill down on time frames, right? Reduce risk if that's part of the plan. That's sort of what the yellow signal tells you. The idea here is that we try and smooth out the noise a little bit. It's trying to be a more intuitive way to sort of trend follow and to not get whipsawed. And right now we see most of these sectors under pressure. So it will be interesting to see how this follows up next week. This is an indicator available for TC2000. It's also available for TradingView as well. Now let's take a look at market breadth underneath the hood here. 52-week highs, 52-week lows. What's going on? If we look at this ratio here, Friday definitely started to spill over into the sellers' favor. Notice though, we still made more highs than lows on Friday, right? These numbers are not finalized perhaps just yet, so we'll see how this all finishes out. But generally speaking, like we talked about last week, market breadth has been good. We've been waiting, we've almost been conditioned for so long that these Mag 7 stocks, the top 20 stocks, let's call it, really have been carrying this market higher. And we're starting to see the opposite happen here, right? We are actually now seeing the Mag 7 stocks roll over, the heavyweights roll over, but there are the smaller companies underneath the hood that are starting to attempt to defy gravity here and work higher. The problem is, of course, with the S&P 500 or these market cap weighted indexes is that they are market cap weighted. And so when the small stock moves, it's not really offsetting on an index level. But like we've talked about, underneath the hood, there are different stocks leading. Some of them, of course, now are a lot more defensive in nature, which may not be too exciting for active traders, but that is starting to be that rotation continuing underneath the hood. Financials have been strong, and then a lot of the healthcare and some of the other sectors that we've talked about in the last couple of weeks. But bottom line here, breadth skewing a little bit on Friday now, starting to get into the seller's favor, but generally speaking, still fairly supportive here. We'll take a closer look at that in just a little bit. We'll make a quick pit stop here for IBD, Investors Business Daily. Thanks to them. They are a sponsor of the show. This is their top 10 on their IBD 50 list. Their top 10 certainly seeing some pressure this week as well, but you can get access to their IBD digital subscription, which gets you access to their IBD 50 list every single day. There's a link in the description of this video. You can support the show, support IBD with that link in the description of this YouTube video. We're going to move right along here to our macro slide. You can see that the dollar index was down this week. We still have a series of lower lows, lower highs being printed here for the US dollar. And if we take a look at Treasury, the 10-year Treasury yield on the bottom right, you can see that we did march lower this week. So we actually continue to see weakness here, softness in the 10-year Treasury yield. So for a sort of a change of character here, and we've seen this over the last couple of weeks, but we're actually seeing the bond market now act as a bit of a safety haven. It's becoming a rotation spot, a defensive place to perhaps move capital outside of, call it tech risk, and find some safety in the bond market. Of course, we also have the bond market pretty savvy on what the Fed is going to be doing here over the next few months, let's call it. So that dynamic continues to play out. Yields were down across the board, and then for commodities, it was basically selling pressure just alongside of equities. Oil hitting the hardest here, 7.25% down, and Bitcoin another big week down, almost 9% on the week. So let's get into it here. Let's take a look at some of this damage, this carnage. Let's see if we can map out where the heck we are. A couple of things to note. So when you throw on your weekly chart here on the S&P 500, let's look at volume. I've got dollar volume on my chart. I just prefer looking at that, but volume is going to track pretty similar here. But dollar volume, look, it looks like it's not a heavy week of volume, but it was because we had a holiday shortened week here. So we only had 4 trading sessions. So when you're looking at some of your charts, you might say, you know what, the selling wasn't that intense. Well, if you add another day in here and it tracked on a similar scale, then you would have had probably the heaviest volume trading week that we've seen, perhaps going all the way back to April. Might have even eclipsed the late or the start of August on that down week that we saw in the S&P 500. So keep that in mind when you're looking at your charts. But here's the weekly picture of the SPY. We usually look at the S&P, the cash settled market. So here's what we got. We've got a market now that made a very definitive move lower here on a weekly basis, right? When we analyzed this chart last week, we were looking something along here, right? We were looking at this range, very innocent at the time last Friday, saying, look, this is consolidating right underneath the highs. And we thought that the jobs number, the jobs report, would likely be the catalyst here to break us out of this range. So a couple of things that certainly did not happen. It did not take until Friday for that catalyst to occur. It took until just Tuesday. Tuesday is one of those days where we should be taking notice, right? I always like to call out days or weeks to take notice. There are lots of noise in markets, right? Lots of noisy days that really just don't add a whole lot to the underlying story of where markets are headed or what the intention of the market might be. But then there are those few select days where you want to be taking notice. There was something notable happening. Volume picked up, range expansion happened, a gap reversal, something big, notable that makes you go, okay, there are clues in this price action. Tuesday was it. I mean, Tuesday was the breakdown in range, right? So when we talked on Friday, we said, look, we've got a very clear range drawn here. It's about 1.5% high to low. Let's pay attention to that. That's our signal. That's our breakout signal. We know volatility compression leads to volatility expansion. We see it time and time and time again, and we'll continue to see that. And we did get that volatility expansion. It just did not occur perhaps at the time we expected. It happened on Tuesday versus Friday. And it also didn't really favor the path of least resistance, right? I think the bias, certainly my personal bias, was that it was on the bulls' favor here, that a breakout could occur to the upside. But that was not the case. We got a quicker breakdown and it occurred to the downside. So Tuesday, I think, was a day you certainly are taking notice of your risk, your, just checking your direction. All of that really happened on Tuesday, and it was pretty spectacularly perfect here from a technical perspective. These are pretty much the weakest looking follow-up days you could come up with. There was just a very small attempt here to bounce intraday both of these days, but you basically got hammered back down to just going totally pinned sideways here, compressed, pinned against sort of this breakdown bar. And then you had another sort of beautiful expansion bar lower here in the S&P 500. So this was quite textbook weakness here. Just came out of the gate swinging to the downside. No attempt to bounce, and then a follow through move lower. So penalty box all around. Tuesday was a day to take notice. Friday was another day to take notice. You got 4 days down in a row. It's a little bit tougher to panic now because you certainly have some oversold conditions set up for you now. If you throw on Bollinger Bands here, I mean, we're not quite at the lower Bollinger Band, but you can certainly see where, we've made a pretty good move lower here. We filled some gaps. And now when we talk about retracements here in the S&P 500, we've got basically a 50%, let's call it, no, not quite, 45% retracement to the August lows to where we were just last week at the highs. So I think, as technicians here looking at markets, figuring out, opportunities looking forward, I would be looking at these retracement levels. I'd be looking at stocks this weekend while doing homework. Where were we on the August lows just about a month ago? Where are we in relation to that? And how much have we given up, right? So the S&P 500 right now is about 40% retracement. I would say that in that scheme of things, it's not a terrible look, but, right, objectively, this breakdown bar here, this expansion in range we saw on Tuesday and Friday, that's not exactly what you want to see on a healthy looking retracement. Let's go to the QQQ, and I think this illustrates nicely here. Nasdaq, let me take off Bollinger Bands. Nasdaq 100, last we talked on Friday, looked like this, right? This looks like a healthy consolidation, right? This is a fairly constructive, orderly consolidation. You're grinding lower volume, not a lot of range, not, any big dramatic days, not covering a lot of ground. This looks healthy. If we flash forward to what happened this week, this does not look like healthy retracement action. This looks like get me out trend, sort of trend reversal type action here, or, something has tipped into another catalyst going in the other direction. So you definitely, in my mind, lose some points for the speed and urgency and pickup in range, and just the way we navigated this week was very sloppy. So, glass half full when you're looking at the SPY, that yes, we're now basically at a 45% retracement from the August lows. That, generally speaking, is still considered orderly or normal in lots of markets, right? Zig and zag, you go up, you go down, you breathe. You don't just go up in a straight line. You don't go down in a straight line. Markets need time to digest and retrace and rally. So for the SPY, right? For the SPY, I think we're coming into a spot now that looks, like we would want to see some support come in. Call it a 50% retracement. Call it this pivot low here from the end of July. This is where you'd really want the market now to start to solidify, to stop with these big range bars, see the VIX come down, see ranges compress, see stocks go sideways, see buyers step up. That's, if you're bullish on this market, that's what you want to see sooner rather than later. If you continue to see these days stack up here with another hard sell day, then you're certainly going to be hard pressed and start to want to think about retesting these August lows down here, which really is not the, is certainly just not, it's not ideal, and it's not ideal in the amount of time that we're, would potentially get back down there. So, you kind of have just this mixed opportunity. Now, SPY is one of the best in the house here, because if you look at the Nasdaq 100, this looks much worse. It was down more sharply this week. It's been underperforming the SPY. We've been talking about that. Look where it is, just on this high to low range, right? So take a look at the highs from Qs back here in July. Look at the lows from August, and it's sitting at, say, the bottom 35% of that range. That looks different than the S&P 500, which is still, kind of hanging up in the top half of the range. So that point, we've been talking about it over and over again, but it just continues to play out. Price action here was pretty abysmal in the Qs. I mean, again, I think the best case here is that you're just oversold on lots of different metrics right now, but you're certainly giving up more like 60% of this August rally. So it's fairly slippery right here. You really need to see buyers step back in pretty quick. Otherwise, you're just talking about probably a longer period of sideways and just, kind of waiting for more stabilization, some more catalysts, some more perhaps economic data. Elections obviously now going to be front and center here for markets. And so, the technical damage is going to stack up if you don't hold here pretty quick. So Qs obviously continues to be a really tough spot. IWM, you're back below 210. Remember, 210 is that area where we've been looking at for the S&P, for the Russell 2000 to hold. You kind of sliced through it on Friday here. Again, a much different look than the S&P and the Qs. You got kind of now a potential lower high developing here. But again, I think all of these markets now are kind of stuck in no man's land. You're above the August highs, you're below the cycle highs here, and so you're kind of in this middle of the range, call it 40-50%. And I think now is really got to just ask yourself what kind of trader you are. Don't get, this is the time where it's easy to get chopped around. Markets could go directionless here for a couple of weeks. We could be up, down, just kind of oscillating sideways. So be careful not getting chopped up. Do your homework, look for your stocks that you're looking to enter into, or potentially de-risk from if you think these, if you think this sell-off has started to break some more significant trends. So that is the way I am sort of looking at it right now. Let's move along here because we are tracking pretty long. That's it for the major markets. Okay, so let's go to gold. Let's take a quick tour of here. So if we look at the weekly chart, it was down just slightly here, but gold has been still just such a good place to be. It's acting as that hedge. It's holding up in this market turmoil, and on the year, right, this is pretty impressive. It is up 21%, right? So the S&P 500 is up 14%. Still a great year for the S&P 500, but gold, it's up 21%. So it's just been an impressive move here for GLD. I mean, still have a position in our Galahad trading system, but it's kind of a fixed position on it, so that's to be expected. But you know, if we look here just again at GLD, I mean, if you continue to see this market turmoil pick up steam, then GLD is still, you know, holding up quite well here, and it's now fueling up in this nice sideways kind of range. So GLD, just had to give it props for continuing to work in this environment. But if we go to USO, that's not exactly the same picture here. So oil had one of its tougher weeks here. It was down 7.28%. If we throw that on our rolling returns layout, this is pretty much the worst week since 2023. And if you go beyond that, you got to go back to, basically 2022. So one of the worst weeks in a year or two here for oil. If we zoom out and look at this picture, I mean, you know, it's been hanging out in this range, but it certainly was trying to get its act together in here for some time. Basically the second half of 2023, first half of this year, was looking like it wanted to maybe take a run on this 80 area. That certainly did not happen. And now you're starting to break down from, even the May lows here for oil. So I think, when you're looking at this now, of course, USO is not the best proxy, but it's just what we got here for stock traders. Then you're starting to look at these 2024 lows here, right, where we opened up the year around $65. That's the next, big kind of technical level. And it's a big one because it really spans kind of multiple years down here in the lower 60s. So USO looking exceptionally weak right now, kind of breaking down, putting a lot of pressure on certainly energy stocks. Now, let's flip it back to something else that's acting well right now, and it's Treasury yields, or Treasury bonds, I should say, Treasury bonds. So this is the 10-year IEF bond fund here, and take a look at the resilience. So when IEF goes up, we've got 10-year Treasury yields that go down. Take a look at the TLT. TLT here is looking pretty good, right? It took all year long. I posted this chart on StockTwits and Twitter this week. It took all year long to sort of base out, to find some accumulation, to find some, buyers stepping in here, but it's now back to these January highs now, and it's testing them. We got a reaction that failed on Friday. We did get some heavy volume traded, but let's keep an eye on it. I don't think it's one and done out yet. I think there's still some, good support, kind of dip buyers, and some trend in motion here. I do have a position in TLT, or our Galahad trading system has it in fact owns it through the TMF is its desired exposure. So this is the 3x leveraged ETF, and this has been a position we've had on here. So it's not a brand new one entering today. But we're looking for higher prices. They're looking for this trend to continue, and we'll see if it can. So that covers a lot of the majors. I missed the VIX, but we talked about it at the top of the show. Is back above 20. Certainly nowhere near, at least not yet, where it was at the beginning of August, which was up, of course, in those nosebleed territory levels. But it's certainly got a bid to it. It's closing above 20. So there is certainly fear out there right now in the market. And things are a little bit oversold. So it just depends on time frame on whether or not that's attractive to you yet. There's some technical damage, that's some stacking up, but there's also some short-term oversold readings. And then it really is going to come down to sectors that you're looking at. Technology continues to be just a really tough spot to be. So I think that kind of, high yield credit. I did want to talk about that. I mean, if we look at just HYG or JNK, both of these ETFs that track the corporate credit, high yield credit, is still just intact. I mean, it's not rolling over. It's not, forecasting any type of doomsday or some big stress that the equity market is now just catching up to. It's been pretty resilient here. And in fact, on the week here, it was almost flat. So it's been, still pretty resilient in that arena. And if we really just sort of finish off here with our strongest and weakest stock layout here. What I would again encourage folks to look at here as you're doing that homework, like we sort of talked about already, but just keep an eye on stocks as it relates to those August lows. Pay attention to that retracement level. You know that the S&P 500 is down, call it 45% retracement. What are some individual stocks doing, right? So for one small example, I've posted about this and I have a position in Palantir. I mean, this is a stock that's holding up very well right now. It is in technology. On the weekly chart, take a look. It was down 3%, so it's not like it was immune to any of that sell pressure this week. But take a look at the August lows down here. Take a look at the overall trend trajectory. I mean, this is certainly exhibiting a lot of relative strength here. Again, when a market's getting crushed, long setups by nature are still going to be under pressure, and it's not going to be an easy ride, but you can certainly start to do your homework, pick your levels, be patient, dollar cost average in, know your risk. That's what this is all about. So I'm not going to go through actually everything here just because we're already running pretty long and I have to run, but hopefully this video was helpful for you. As always, we do it every Friday, our long form market analysis videos. We got links in the description for more. If you want to know more about the trading systems we have, Galahad, which we mentioned a couple of times, check out the links in the description of this video. And don't forget to support our sponsor there, IBD, in the description of this video as well. Take care. Good luck next week trading out there. I think we all would love a little bit of an easier week to manage across. And I hope you have a great weekend. We'll see you back here next Friday.